Hello? Perfect. Welcome back, everybody. I hope you're suitably refreshed. Please do bear with my voice. Seems to be a common theme today that people have colds and coughs, but we'll push through. So this session is going to be looking at preventing a disorderly transition. So we'll be exploring scenario analysis tools, risk frameworks, and stress testing. So a deeper dive into how we manage our risks. Just to highlight, there will be a poll question which will come up during the discussion, which is going to be asking, does your institution have a clear understanding of the risk implications of climate to your assets in your portfolio? So our virtual audience, please do partake in that. To our in-person audience, if you go on the OnFifth event app, it will come up there, so please do participate in that poll. So I'm joined today by some excellent panelists. I have David Jan Jansen, who is economist of financial stability at the Netherlands Bank. I have Stephen Rostein, who is Managing Director at Accelerator for Sustainable Capital Markets at Ceres. Satoshi Ikeda, who is Chief Sustainable Finance Officer at Japan Financial Services Agency. Livio Straka, who is Deputy Director General of Macroprudential Policy and Financial Stability at the ECB. And hopefully joining us virtually is Elias Albagi. Hi, Elias, who is Director of Monetary Policy Division at the Central Bank of Chile, and is also their Chief Economist. So welcome all, and thank you so much for joining me today. We've already talked a little bit about the risk implications of climate, but I think just to set the scene and to kind of go into this discussion, I think it'd be great to hear from you on what you see the risks associated with climate change are, how your various institutions, obviously we have 3 central banks here, are dealing with those risk implications. We'll go a little bit later into the stress testing methodologies that are being utilized, but yeah, perhaps David, I'll go to you first, just to introduce yourself and touch upon how you see risks in climate change. Many thanks.
Thanks also to OnFifth for the invitation and putting together this great event. My perspective, I think, that I can offer to this particular panel is very much indeed a financial stability perspective, and within that, let's say, the whole discussion on scenario analysis and or stress testing. So that's also very much, let's say, the experience that I have at the Nederlandse Bank, starting a few years ago, and I think. Perhaps 1 or 2 things to say there by means of introduction, and then I think we can always dive deeper later on. So I think to me personally, I think I've seen throughout the couple of years that I've now worked in this area great progress. I think from a setting where we sort of had the notion that we need to think more about these climate shocks and these climate events and the bigger trends surrounding climate change, because we think they are at the end of the day financial risks also, and I think I do see, let's say, a journey where we've made, I would say, progress, and perhaps even great progress in terms of going from that qualitative discussions to quantification, so that we now have, let's say, different sort of examples, exercises that we've done where we actually have, to the best of our ability at present, run the numbers and can have, let's say, a conversation based on those initial insights. I'm sure that throughout the panel we will touch upon the different types of climate shocks that we can consider, whether it's transition or physical. So perhaps I can sort of leave it here for the moment. Thank you.
Lovely, thank you, David. Elias, maybe I can come to you next for quick introductions and how the Central Bank of Chile is seeing the risks of climate change and dealing with that.
Thank you. Can you hear me?
Yes, can hear you well.
Great. Well, thank you very much for the invitation to participate in this panel. Before going in detail in what the Central Bank of Chile is doing, I think we need to clarify an important concept, and it has to do with how we understand our notion of risks. So something that might be a financial crisis, right, is developing in the world right now. We're in the middle of the monetary policy report that involves doing forecasts. And when we do forecasts, we typically start with a baseline. The baseline is the most likely scenario. And then we study deviations from that scenario, typically lower probability event associated with, for the most part, with negative consequences, that we call the risk scenarios. But unfortunately, this is not the way in which we talk about climate change. I think we're misusing the concept, because we talk a lot about climate risks, but if you see the report that the IPCC put on Monday, the synthesis report that basically summarizes the sixth assessment report, they basically say that in 10 years, our baseline is that the temperature will have increased by 1.5 degrees in 10 years. So basically that's the Paris Accord. We basically did not meet the Paris Accord. That's what the report says. And it says that towards the end of the century, the temperature is going to be between 2 and 3 degrees warmer, given our current trajectories and our current commitments. So just to kick off the discussion, my point here is that the baseline that the scientists are telling us is what we would have think 20 years ago was a pretty bad risk scenario. So I think we need to stop talking about risks and maybe change the language to impacts. What are the impacts on the baseline scenario? Those impacts are not good. They're not good given the trajectory that we are already in. And at the bank, let me just say something for something more general, and then we can dive deeper into the details. We are working hard on trying to assess both the macroeconomic and the financial risk implications of these scenarios, right, of these impacts, by what I would call a top-down approach, which is a little bit different from the bottom-up approach that is more commonly used, and I can get into the details about this later on. But essentially, it starts with scenarios, say from the IPCC or the ones considered by the NGFS, and then starts from the macroeconomic implications, working ourselves down to the level of firms, the exposure of firms to both physical risks and transition risks, and then how that maps into the condition of the financial intermediaries that provide loans to these corporations. Let me just stop there, and perhaps we can go into detail in the next round.
Yeah, thank you, Liz. I think that's a great way to kick off the discussion, and indeed we can go a little bit more into how we measure the transition versus the physical risks and what the results have been and our understanding of those. But Livia, maybe I can go to you next just to introduce yourself. I don't know if there's anything to add to what Elia said there, and what the ECB is looking at in terms of a risk assessment.
Yeah. So first of all, again, so thanks for the invite. I'm also impressed by the room and the paintings. So I find a lot of wisdom in these people in the paintings, and let's sort of be equally wise or wiser maybe in the case of climate. So the ECB was already mentioned in other panels. So it has a clear strategy with a number of actions. I would say some of them are totally uncontroversial. For example, it's investing more in models, in understanding climate risk in models and so on, in data. Others might be slightly, less than controversial, which is like it was already mentioned, tilting the bond portfolio. Actually, the Euro system has also two types of portfolios. There is a monetary policy portfolio and a non-monetary policy portfolio, and those follow different rules. The second one is more decentralized at the level of the national central banks. The monetary policy portfolio is more centralized, but so there are several. So I think this action is is multi-pronged and is a considerable part of our work. But I would also emphasize that there has been also a debate of it's a bit about the mandate. So whether this is allowed, or even some people say mandatory based on the European Treaty. So if you read the European Treaty carefully and with a certain interpretation, you could even argue. I personally, tend to believe that the treaty even kind of forces the central bank to at least to cooperate with the other authorities on climate, not to be the climate policymaker, of course, but to cooperate with others. As you know, the treaty says that the ECB should also support the other policies of the European Union, which are contained in Article 3 of the treaty. And Article 3 of the treaty also mentions environmental protection. So you could argue that this is even mandatory. I mean, not everybody agrees with that, but I would say is at least not inconsistent with the legal mandate. But of course, it is a fine line. Again, so in the range of possible actions, there are some that are totally uncontroversial. everybody would agree with it. There are some where there could be debate. Those are where probably more debate is needed. But that's what I would summarize this stage.
Yeah, no, thank you. And I think it's a good point. We all are in agreement that risk is a part of central bank's mandates, and it's very clear that climate does pose a risk, which is why I think a discussion like this is very fruitful, but also we hopefully will see some real progress in this as well. I think there has been a lot of progress. So, Satoshi, maybe over to you from the Financial Services Agency perspective and your role. How are you seeing risk, and what are you integrating into your assessments of this?
Thank you for that question, and thank you for having me today here. Well, Financial Services Agency is a supervisory body for the banks and the insurers. So we do not necessarily have a kind of reserve management as the central banks do. But in terms of our mandate, certainly the securing the soundness of the individual financial institutions and securing the financial stability of the financial system is certainly a mandate, and we view that the climate change issue is very much relevant with that mandate. And so our starting point is that the climate change is a source of financial risks. And certainly it doesn't necessarily create a new risk category, but certainly a risk driver for the market risk, credit risks, all the kind of risk that the financial institutions are exposed to. And also putting into that discussion a certain time frame angle, that creates a certain interesting question. First of all, Mr. Malkani put forward the concept of the tragedy of the prison, and that is certainly very much relevant with the financial stability discussion we are taking in terms of climate change. And if the people or the economic actors are ignorant of the climate risk, whether it's a transition risk or physical risk, then all of a sudden, maybe risk perception changes, as well we witnessed for some Silicon Valley Bank or something like that. So climate change could be one of the trigger factors for the financial stability in that sense. So we need to deal with that. And also, well, in the normal practice of risk management, we tend to separate, short-term and long-term. And usually the, short-term risk management practices deals with the 1 year time horizon of the risks. So in that sense, it resonates with how we design the capital adequacy ratio requirement and so on and so forth, and how we can incorporate the sort of long-term consideration into our overall risk management framework. That is a challenge. And actually, I remember that some of the panelists raised the issue of Basel IV, the new capital regulation framework. But certainly that could be an idea for action in the future, but I stop here. Thank you.
No, thank you, Satoshi. And Stephen, I came to you last, mainly because you are the non-policy maker here, I guess, on the panel, and I think it'd be really interesting to hear what Sirius is doing, how you're working with the policy makers, and again, how you're seeing risk and progression that you're seeing in this space.
Sure, thank you, and thank you for hosting this, and get so many smart people in one room. So first, Sirius is a nonprofit. We do a lot of research and advocacy in this area. I guess 3 quick points. First is the investment. We have investors that are part of our network. There's over $60 trillion of assets that have made net zero commitments. They want the companies, and they're literally putting their money in their mouths. Despite the question earlier about politics, politics is not going to drive the market. The market is still moving in that area. So investors are wanting more opportunities, number one. Number two, we've done research on the banks. We took the top 24 banks operating in the US, but many of them operate in many of your jurisdictions. And we looked at using the ECB methodologies that physical risk, transition risk, looking at derivatives, there is hundreds of billions of dollars in risk for climate. Let me put it another way. There is many times more risk on the bank balance sheets today than there was in 08 because of subprime housing, many times. So third quick question is, well, that's the big banks. Small banks, while they obviously have a much smaller base, they tend to loan much more locally, and they are disproportionately risked because if there's a fire, flood, or a transition, so that the small banks, again, while the asset size is small, the disproportional, so there's risks on a variety of these, and appreciate the leadership, and all of us, series included, all need to do a lot more faster.
Thank you, and an excellent point there. So I guess my first kind of question is, how can we adopt current risk models into climate? So how can we use current stress testing tools to understand our climate risk, and what are the challenges with that, and what are the progresses that have been made? Livio, maybe I can go to you first with this.
Yeah, so obviously, climate change is a slow-moving process, and highly uncertain. So it's not easy to quantify in the standard terms. You could call it 90 uncertainty or whatever, but it's certainly not. Not a clear distribution. So also, climate is both climate and economy are complex systems, and there is a technical definition for complex system, and they also interact. So it's a complex system squared in a sense. So that is tell you the scale of the uncertainty. Regulatory community, but also private sector, we use scenarios as a way to obviate to this high uncertainty. So we imagine possible futures. We say that these are let's design, as the NGFS does, 6 possible futures. At least they are internally consistent. So the stories are stories. So they are not forecasts, they are stories, but they are internally consistent stories. It's like a movie where there is no, let's say, no discrepancy. So if you are watching a movie on ancient Rome, you will not like to see a watch. These are internally consistent futures, and then you can see how different variables move around these possible futures. Yeah, that's how we cope with this high uncertainty in this environment.
And we've heard a lot about the NGFS already today. So how has the NGFS supported the development of stress testing and scenario analysis understanding? Has it kind of become the benchmark? Maybe, Olivia, I'll go to you on this, and then
Yeah, so first of all, the NGFS scenarios are they've been mentioned already, and so just also let me mention the DCB is now leading the work on the scenarios. Is part of the reason why I'm here also is to communicate on that. And also, if you have also questions on the NGFS scenarios, you also encouraged to reach out to us. So we have a team following that, and there's also the secretariat in Paris. So I already kind of mentioned what the scenarios are. So the NGFS scenarios are possible futures that are internally consistent. They bring together climate scientists and economists. And the conversation not easy sometimes, because they speak different languages. So when I attend these meetings with the climate scientists, I'm always puzzled in the way they reason or they speak. But that's obvious because these are different communities. I guess there are perhaps we can go later in more detail, but there are a few key questions. So one is, so how will the transition take place? So what policies? Because up to a couple of years ago, I would say carbon taxes. Everybody was expecting a kind of global carbon tax and so on. I think especially now after IRA in the US and so on, I think the discussion has been shifted. So now there is more discussion about subsidies more than taxes. So this is a kind of a key question, which also informs a little bit the scenarios as well. So we design scenarios with subsidies or carbon taxes, the key tools. That's one key question. The other, probably a couple of other key questions. One is how to model physical risk. So if you were to design a stress test now, then the current risk of a physical disaster now is probably not very influenced by climate change. Because we expect climate change to happen in 50 years, in 30 years. I mean, it's already happening, but we expect the bulk of the effects to come later. So how do we reason now if we want to stress the financial system? So do we use the current climate and the current probability of events or the future one? So that's the other probably the last key question is the short term. So the transition, the energy crisis was mentioned already earlier this morning. So how is the energy crisis making the transition more or less likely? My point there would be that the economics of it should make it easier. But the politics may make it harder. So there is a conflict between economics and politics. So what kind of short-term scenarios can develop out of this energy crisis? And this is part of the new work we are doing under the NGFS scenarios. So we are working on short-term scenarios that address a little bit this question. But perhaps I stop here because otherwise I could speak for very long on the NGFS. It's better that I stop here. Thanks.
No, thank you. And I think we can definitely come back to some of those points as well. Elis, maybe I could bring you in here just from the Central Bank of Chile, how you've been adapting your current stress models to integrate climate, the challenges that you face with that, use of NGFS, and also whether the NGFS has kind of taken in more kind of local jurisdictional capabilities and understanding, and whether there have been challenges with that as well, whether you've adapted things yourself a little bit in terms of the NGFS scenarios.
Thanks. Well, that's a lot to unpack. So let me start with what more concrete example of what we have been doing at the bank. So there are basically two ways of going around stress testing or the assessment of climate risk, or what I would call climate impacts more generally. The first is the bottom-up approach. Essentially, that relies on asking firms, be it non-financial corporates or banks, to do an assessment of the exposure that they have with different methodologies, and they report this assessment, and you aggregate this to some level that is appropriate for the question you want to answer. The other approach that is much more data intensive, and due to data limitations, it's not very often performed, is the top-down approach, which you start with, say, a scenario from the NGFS, for instance. You start with the macroeconomic implications, you downscale that to the sectoral level, and then you try to make an assessment of what the risks, the physical and the transition impacts from climate change are in specific firms of those sectors. So for example, in the case of Chile, with this methodology, we've identified that the main sectors exposed to climate change, not surprisingly, are agriculture, mining. It also is some important asset classes, essentially residential and commercial properties that are exposed in coastal areas, also sort of jump as a yellow or red flags in some cases. I think it's important for me, that's the ideal approach, right? Because it has the main advantage of being a common metric that doesn't rely on self-reporting, and therefore is, I think, robust to some incentive issues that appear when you just rely on data that firms self-report. But it does require a lot of data, and it does require a lot of working modeling. So probably the ideal situation would be to have both approaches, right? So what firms or bank reports, and you can contrast that with the analysis, with independent analysis that you perform yourself, say as regulators or as a central bank, and then you have something to contrast what the risk assessment that you're getting from the self-reporting side. Let me just very quickly say a few words about the NGFS. So we are also part of the NGFS, quite active actually. I myself am now part of this monetary policy group, in particular the model analytical approaches subgroup. And what I can say about the work of the NGFS first is that it has been hugely influential and very useful. As was said here before, there are basically self-contained, internally consistent scenarios. And I think that's a very good starting point. But that's important to understand that they are starting points. They are not the definite answer for a specific country. I don't think they're meant to be, right? They are a useful guide so the countries can say, okay, this is a way to start. These are models that I can get started. But in the end, there's no substitution for doing your own homework, given the realities of particular jurisdictions. And just to finish up, the other thing that I would say about the NGFS, which is also a disclaimer that the reports of the NGFS, they make it quite plain. There are some things, important things, that are not included in the models that are used, and therefore do not show up as climate impacts, but they are nonetheless very important. The main one is that the physical impacts of climate change are probably underestimated. And they are underestimated because it typically uses linear effects. And we know that the effects of climate, especially when you start, deteriorating ecosystems, start to become nonlinear, and you can even cross tipping points. And those are very hard to model and therefore are not modeled there. But like I said, the authors of these reports are very open about this. They give this as a disclaimer. And this actually shows up. I mean, when you do your analysis at the country level, you are really pressed on finding large effects. Like if I take a drought that lasts 5 or 10 years in the central region of Chile, sure, it'll show some effects on some regions, but in general, given that we're estimating these models with the last 40 years of data, the effects are not that large. And I think the reason is that we have been living in sort of the linear part of the effects, and now we are shifting, actually quite fast, I would say, into the non-linear part. And that's an important challenge, because when we are predicting the future, the next 5, 10, 20 years, I think we need to do a better job in trying to calibrate the non-linear part of the effects. And that for sure is going to amplify the impacts of any scenario that we input into these models. Let me just stop here.
It may be a big question, but how do we factor that in? How do we adapt to those changes and to the bigger shocks that are seemingly coming? That was for you, Elias. Sorry, not letting you go yet.
Well, so that's a good question, and let me tell you something that we're trying. So what you could try is to use like extreme events, right? So there are many climate events, like the average event that, as I was saying, doesn't have, in the last 40 years, doesn't have a big impact. But then you can find some extreme events that in some particular, grids of the country have actually been quite strong. And if you take that subsample of very extreme events and estimate reactions and the effect on ecosystems and on economic activity, for instance, on the firms that are located in those specific regions, then you can get closer to effects that look a little bit more nonlinear. And our preliminary results are actually giving us, of course, stronger effects in that regard. And we are struggling on how to use these sort of parameters to calibrate a more general effect that we could expect at the economy-wide level going into the future as we start hitting these non-linearities.
Thank you. Satoshi, do you have anything to add to this and the use of the NGFS as a model and how you've integrated that at FSA?
Sure. Certainly the NGFS scenarios have been very instrumental in harmonizing our work among the many supervisors and regulators and central banks in attempting to stress test banking, also banks and insurers in terms of climate change. And well, when it comes to the issue of risk modeling, in a simple term, conceptually, in order to assess the transition risks, we changed certain parameters around the carbon price. And we build a certain path of carbon price scenarios, provide a path for that carbon price. Carbon price is a kind of expression of the certain strengths of the climate-related regulation, not only including a certain real carbon price, and that certainly helps. And also in terms of assessing physical risks, the information provided by NGFS scenarios are very much instrumental, although, we would like to, if you are to quantify the physical risks, we would like to have a certain model that that connects between temperature rise and then how weather system would change and how that will create a risk of natural disasters or sea level rise. and so on and so forth. But unfortunately, we don't have that kind of a comprehensive risk model for physical risk. So we need to feed very specific individual information on the physical risks into the risk modeling. So while NGFS scenarios are very helpful framework for designing our stress testing exercise, but there are still many gaps to be filled in the future. And also, as Elias mentioned, in terms of physical risks, we do not necessarily incorporate certain non-linear risks into our models. So that is certainly a challenge. But without those elements, with the stress testing exercise using those NGFS scenarios, we can have a certain sense of the overall magnitude of the potential risks to the financial system as a whole and also financial institutions. So while there are many things we must work on still, but NGFS scenarios are very helpful too, I would say. Thank you.
Yeah, no, good, thank you. Stephen, from Siri's perspective, kind of what developments have you seen from a stress testing or a climate stress testing perspective, methodologies that have been used and the results that you've seen, and how are you supporting those developments as well?
Yeah, I think in climate stress testing, we have to look clearly a longer time frame than others. And some, again, here are doing it very well. Some, there's still more work to do in that area. We also have to make sure that we're not looking separately at physical risks and transition risk. I mean, as in around the world, in the U.S., in one day last summer, we were having supply chain disruptions because of the pandemic. We were having Hurricane Ian on the East Coast with about $80 billion of economic loss, and droughts on the West Coast. So we were having physical risk, transition risk, all at the same time. And we had the risk of getting to the Minsky moment of kind of 1 + 1 = 1,000 or 100,000, whatever. So those are two of the ways. And to make sure it's transparent, to have, so that, you know, there's literally in the newspaper today and yesterday, there are questions of what did we know and when did we know it? If you think about what's happening now, at some point, we don't want those questions to be asked about what did we as NGOs or bankers or insurers or central bankers know about those climate risks. So the more it can be transparent is critical.
Yeah, no, absolutely. David, maybe I can go to you now, just in terms of what the Netherlands Bank is doing. I think you have an interesting perspective as you've done an internal stress test on the central bank and its activities. What were the results from that? Yeah, what were the challenges and what methodologies did you use to kind of conduct that internal stress test?
So many things to reflect on, and I think I agree also with many things that have been said in terms of the complexities and the challenges and the underlying uncertainty and the fact that indeed it's about transition and physical. So it's quite a broad set of challenges that we have, and we haven't even talked about data yet. So that's going to probably going to come on top of that. So. With that in mind, I think when I think of the different exercises that we've done at the DNB, and I sort of reflect a little bit on that and step back. So we've done, let's say, 2 or 3 sort of exercises where we looked at different aspects of climate change. And I think if anything, I think that we, at a certain point, at the start of each exercise, we have sort of this notion of how to say it. Let's have the perfect be the enemy of the good, something along those lines. In the sense that this is challenging, this is complex. We need to start from climate science. We need to start from different kinds of projections that stretch out way into the future. We need to think about the way this is going to land in the real economy. We have to think about how this is going to land at the institutions at the end of the day. And then we get, perhaps ideally at a certain point, at sort of the question, what is the effect on, well, financial stability? So I think, if anything, what we I think in all of those exercises have done is also, let's say, think very clearly about the scoping of the exercise, and perhaps not always start from the very big picture question. Okay, climate change in the broad sense, but try and narrow it down sometimes a little bit. To give one example, to make it, let's say, a bit concrete, is we have some ongoing work on flood risk. which is coming from the Netherlands, one of the top of mind physical risks that you think about in the context of climate change. And there again, you can sort of start all the way at the beginning of this whole chain of events where you look at flood maps and think about probabilities. And the good news is that in the Netherlands there's good flood defense in place. So as Livio was already alluding to, from the present day perspective, that looks, let's say, pretty reassuring for the moment. But I think what we also do, in addition to the scoping, is that we always try to look for, let's say, our comparative advantage. So the risk modeling as we have it, the data as we have it, how can we leverage that to speak to, let's say, the question as we have it? So do we have, let's say, information on exposures that financial institutions would have to flood events? How can we look at that data? How can we incorporate flood specificities into the risk modeling? We know a little bit about how to do risk modeling, but how can we then incorporate the notion that there can be a flood event? Well, then you need to think about the damage that would mean to the collateral, and that would mean that you have to think about the impact on credit risk parameters, and then you get going a little bit, and then at least from that little part of the problem, you sort of begin to get a little bit the sense that we begin to understand a little bit. Now, that still means that there is a lot to discuss, because then, of course, you still need to think about the first bits of that analytical framework. What is actually the flood map that you want to focus on? What type of return frequencies do you want to have in mind there? And so there's still lots of conversations to have. But I would argue that let's say, once you've started from your own comparative advantage, you have something on the table. I already alluded to the fact that quantification helps here to make it as concrete as possible. Then you can further engage with, let's say, stakeholders and discuss in terms of, this was, let's say, the bit of modeling that we were able to do. Let's sort of look at that and further the conversation. Now, to round that off, then in the Dutch context, you start meeting lots of interesting engineers who have lots of ideas about how to do flood risk modeling, and then I think you're in a good place. So that is a very concrete example. So I think when I think about this very complex set of issues, I would sort of think that sometimes indeed the scoping is important, and also leveraging on your own comparative advantage. That's, I think, two things that I would sort of bring to the table from our own experience at DNB.
No, thank you very much. Livia, the ECB has done, correct me if I'm wrong, but I think the biggest stress testing exercise so far, the economy-wide stress test that you conducted last year. Could you tell me a little bit about that exercise, some of the results, the process that you went through, and yeah, your kind of takeaways from doing that exercise?
Yeah, so the so-called economy-wide stress test is a top-down exercise. So the stress test can be of two types. It's top-down, where you say, okay, this is going to happen, and then I model how the banks will react to the balance sheet. The bottom-up is when you ask the banks, what will, I give you the scenario, but then you tell me what would happen in your own bank. So the big challenge in this exercise was to find good data on firms, in particular on emissions and climate-related variables for firms. So there was a huge effort for that. Now, by the way, the new vintage of that is going to be released in about a month from now. So there is a new version of it, and I think there are also, what is also interesting, there are also new scenarios. And part is also related to the discussion we were having before. So there is a scenario which is called wake-up call. So that essentially, so we still go to the Paris objective, but we rush it later. So for a few years we do nothing, and then we all rush to comply with the Paris target. Or there is also a scenario where this is further delayed, and we don't get to. So it's delayed, plus it doesn't go into the direction of Paris targets.
So does that go beyond a disorderly transition?
Yeah, it's not really disorderly. It's a bit of midway. So it's not a hot house or the NGFS scenarios, but it's something a bit in the middle, but it's delayed. No? And so all these impacts the firms. But one important aspect we are also looking at a new vintage of stress test is what happens to investment. Because all this transition requires a big investment in the end in renewables. And who does this investment and respond to what incentives? And that's a big question. And I think these stress tests don't really answer that question. So because in the end, I think it was mentioned this morning by Clara, but somebody, I don't remember. So it was mentioned that at the end of the day, we need to change the way we produce energy. And this has to happen. It's a big shift. And so it's not clear is part of the stress of the system also. So how do we model it? What incentives do they? I just wanted to say quickly a word about physical risk, because I think Elias and others mentioned the fact that the physical risk can be non-linear. So this is not completely forgotten in the NGFS scenario. So if you look at the NGFS scenarios, very closely, you will see that in the most pessimistic scenarios, we take some higher moment, so some worse moment distribution, to take into account a little bit this idea that there are these possible non-linearities. So it's not just to say that I don't think that the NGFS scenarios completely kind of capture this non-linearity, but it's also not completely forgotten. So there is some of it in parts of the scenarios. I just want to clarify that.
No, thank you. And perhaps in a second we can go a little bit more into understanding transition risks more specifically. I think we talked a bit about physical already. It'd be good to go a bit more into transition. But Stephen, maybe going to lean on you as hopefully being connected with the FRB, but we've seen that they're now developing their own stress testing model, seemingly trying to start to integrate that into what they're doing. Are you able to tell us a little bit about what that's going to look like? I assume it's in the very early stages, but are you able to give us a little bit of insight into that and into what they're thinking?
Sure. So obviously I don't speak for them, but so there's two models. First, in January they issued draft rules for the 6 largest banks. And to put those in perspective, in 2008, the 4 largest banks were considered too big to fail. They managed $4.8 trillion of assets. Those 4 banks today have $9 trillion. So it's an enormous part of the economy. And those will be issued in July. We think those are a good first step, but it's only a first step. Again, they don't go far enough. They don't integrate physical and transition. There are a number of shortcomings, but it's a good first step. Second thing is the 3 banking regulators, the Federal Reserve, the FDIC, and the Comptroller of the Currency are doing joint guidance that they hope to issue in the next few months for the banks that are 100 billion or more. So that's about 30 banks. And those will go a step further. Just a piece of data just relating to the question of floods earlier. In the United States, the flood maps, if you look at the flood maps, more than half the people in flood areas are not counted in the flood maps. So that it's important in terms of the data. We just did a report on flooding, and there are a variety of recommendations from parametric insurance to microinsurance and other things that can be looked at as well as part of those solutions.
So is that because of lack of data that they're not factored into that?
It's lack of data, and when they were done, the curve was here, and now unfortunately, just in the United States alone, last year we had $165 billion of economic loss. That number, when the maps were done, was much smaller. In some states, and it's not just the coastal areas, there are 2 states where we did an analysis where they had more flooding from rivers than they did from coastal. So it's not just around the coast, it is where the rivers and streams as well.
Thank you. Olivia, I believe the ECB has been working a little bit with the FRB on their developments as well. Have you got anything to add to what Stephen has said?
You mean the floods or what?
In terms of the stress testing that they're developing, the models that they're developing in the States.
Yeah. No, by the way, there's not only one model. There are many.
Sorry.
Yeah, exactly. So there are many different models. Also, as I said, different types of stress tests. Also, both bottom up and top down. So it's.
Sure.
But I mean, in the supervisory one, which was more bottom up, in terms of physical risk, we consider a drought in Southern Europe and floods in Northern Europe. I mean, when we think about physical risk in Europe, we always think of this binary. So the south as a drought and the north as floods. That's always a bit the template.
Yeah, sure. No, good. So I'd like to turn now a little bit more into our understanding of transition risks and how we can map our credit risk and understand our kind of the risk on our asset classes. Satoshi, maybe I can go to you to go a little bit into that and maybe some of the results that you're seeing.
Certainly. That in Japan, there's certainly certain manufacturing sectors are very important industries in Japan, and for example, automobile industry and some certain chemical industry and certain steel industries. And so, we did a certain analysis on how the change of the carbon price would affect the credit worthiness of those companies in those industries through our stress testing exercises using the NZFS scenarios. it certainly exposes certain data gaps because at the end of the day, for example, for the automobile sector, how the individual company adapt a decarbonization strategy is important. Well, certainly electrification is a solution, but well, certain company prefers a certain hydrogen or maybe biofuels or so on. So it is sometimes difficult to assess the credibility of the claim they make in terms of how they decarbonize their operations. But so well, we use a certain information from the IEA scenarios or so on and so forth. But we come to the certain numbers for analyzing that. Well, we haven't found any, well, you know, from this financial stability perspective, we haven't found some concerning results. If you look at numbers, well, if we adapt the potential losses that may incur in 1 year, that is maybe small, but it adapts to the 2050 or 2100, then that number becomes big, and it's a judgment call how we should assess the results. In terms of the number for 1 year, we can say that the banks can reasonably absorb that kind of level of losses with the profits. But given that the uncertainty around the associated with stress testing exercise, how we can tweak that the number we get from the stress testing exercise to assess the real impact. All those things are really challenging tasks for us. So I would say certainly energy affairs scenario helped us to design the stress testing exercise, but we need more data for analyzing the conducting stress testing exercise, but also for analyzing the end results we get from the stress testing exercise. So I cannot say that with confidence that the number we get is a certain indicator for the future action, but we get a sense, and certainly we identify the areas of improvement in terms of how to design the stress testing, and also where we should get more data from. So.
Yeah, no, thank you. David, do you have anything to add to this in terms of mapping our transition risk, understanding the impact on our credit and our assets and portfolios?
I think previously I sort of argued to sometimes simplify a little bit. Now I think I'm sort of going to go perhaps a little bit in the other direction, if I may, because I think transition is sort of a broad concept, but I also think it's good to think a little bit about what we sort of have in mind there. And perhaps the first point that I can make is that when we sort of started at DNB, the thinking was very much thinking about things like climate policy, technology, so very much related to climate change itself. Perhaps I can just note that I also see a little bit of a broadening out of the discussion there to let's say, broader nature-related losses and complexity there. We had, I think, a previous OMFIF event in Amsterdam not so long ago on biodiversity. So there, at least, I think it's important also to think a little bit about what we have in mind here. And I think the next panel is also going to address that. Secondly, and again, here I'm sort of broadening out a little bit. I think one thing perhaps that I haven't heard so much is also the sort of the cross-sectoral perspective. So let's say we've talked, I think, a lot about banks, but at least some of the work that we've done in the Netherlands is also very much from a cross-sectoral perspective, also because that is, I think, very natural for us when we think about financial stability. So the transition work that we did and that we, I think, published in 2018, if I remember correctly, was very much focusing on banks, but also pension funds and insurers, sort of from the idea that this could be sort of common types of shocks that could hit all of these institutions at the same time, but in different ways. So for banks, indeed, credit risk. For perhaps some of the institutional investors more sort of market risk. Coming back to the discussion on the NGFS, I think that was a time when the NGFS scenarios were still very much under development, but I think the thing that we did there in 2018 would sort of chime very well with, I think, what is now reflected in the NGFS scenario. So we very much focused on things like climate policy shocks, carbon pricing, technology shocks, and again, then basically try to work through the models, as I said before, trying to reason from the shocks in a stress test setting. So assuming, let's say, a very severe but plausible shock does occur, so really sort of asking this type of what-if question, how is this going to land in the economy and how is it going to reach the portfolio of the individual institution? I could talk about this for hours, but we have papers available for people who want to see the details.
No, thank you. Maybe we can share that with the audience afterwards. I'm conscious on time, so maybe I'll ask one more question on data and how we can kind of close the data gap and essentially integrate data to use forward-looking metrics and kind of understand our projections. Stephen, maybe I can go to you on that. And then if we have any audience questions, please do raise your hand and we'll come to you.
Yeah, clearly, as was said a few times, we, don't have all the data, but I think, as our colleague said, we can't let the perfect get in the way of the good. So part of it is do as much as we can, and NGFS has done a great job, ECB and many others, and then learn from each other as part of that, because Mother Nature isn't waiting for us to have good data. I mean, as we learned, we didn't have good data on this other nature-based crisis called the pandemic, and we faced dramatic supply chain risks and at the same time physical risks. So we have to invest in data. There are several countries here that already have, for example, climate disclosure from companies. We hope in the next few months the SEC will require it in the US as a piece of it, but then sharing the brilliant work of the many smart minds in this room.
Lovely, thank you. Marcus, I saw you had a question.
Okay, thank you. So again, Marcus Ingholt, Danish Central Bank. My question is on second order effects, not tipping points, but second order effects in stress tests and scenario analysis, whether they are captured, and if not, if you're doing anything to capture them. So my thinking is that these scenario analysis quite well right now illustrate first order effects of climate change and of the same green transition. But there may be second order effects that are much more disruptive but that are not being captured. So as an example, initially Europe's energy transition away from, say, German or UK coal into Russian gas, that was very cheap. That didn't do anything because, you know, the Russian gas just came there, right from Putin. But then there was a big geopolitical shock in the beginning of 2020, or 2022, sorry. And then suddenly we didn't have this anymore. So it wasn't as such a direct climate shock, a direct transition shock that caused the high inflation we have right now, but it was a geopolitical shock, but a transition beforehand that created some circumstances where this geopolitical shock got much larger effects than it would otherwise have had. So if this is something that's being looked into. Thanks.
Thank you. Was that directed to anyone in particular, or?
Well, the stress testing building institutions.
Ah. Elias, sorry, didn't see the little hand. Please.
Oh, it works? Great.
It works. It's very small.
Can I take that question?
We can hear you. Yeah, no, please answer. Please.
So I think you meant second round effects, right? I mean, that are quantitatively important but are not direct effects.
No, I meant indirect. Second order effects. Not second. I mean, so a second round effect. I would say that as, you know, something coming back. But while this is a second order effects, there's some, you know, where you are in the economic system, the energy mix you have beforehand. That determines the effect of, there's some state dependency, that's what I'm meaning. Yeah.
Oh, I see. So, I'm sorry, I had a different interpretation of your question, but I think it could be interesting anyway. You mentioned geopolitical risks in your question. I think this is something that it's fair to say is not present in pretty much any of the analysis, because it's very hard to model. So one that sort of haunts me, and I like to think about this, but I'm not sure how we could model it. It has to do with the effects of climate change on migration, and what that affects, the impacts that can have on geopolitics, on political polarization in countries. So if you look at history, I mean, all of the important climate changes that we've experienced have been associated with mass migration. And actually, this is very well documented, that the indirect effect of migration tends to be much larger than the direct effect of the climate change that produced the migration in the first place. And this is something that, I mean, some people are aware, but it's really hard to model. But I'm afraid that we might be missing the most important part. And for that, I think we need to, get people from different disciplines talking to each other and perhaps working on a joint effort to try to start getting these other aspects into the discussion, because they might be actually quantitatively more important than the direct effects that we are more aware of.
Thank you. Yeah.
So another comment I would have in this context is that so we know that there is a huge literature saying essentially that so producing commodities, as a political effects on the political system. So countries producing commodities tend to have worse institutions and tend to have also a worse distribution of income. And there is a very solid literature on that. So I think the hope is, related to what you were saying, the hope is that a transition to renewables would also change the production and shift the production more towards democracies, towards countries with better institutions and with less predatory system. Unless this is also prevented from the availability of metals such as lithium or so that could be the weak point of that. But in theory, the production of renewables can be done in democracies, while so not only is fossil fuel produced in autocracies, but it's more than that. So it's the production itself that leads to autocracies. And so this becomes a vicious circle. So this geopolitical link is very important. I think I agree, is a bit underestimated.
Yeah, no, thank you. I think we had a question over there.
Hi, this is Mark Cliff from the London Institute of Banking and Finance. I'd just like to follow up on this point, because I think there's, if you like, the legacy of traditional risk management hanging over this whole discussion, which is that you have to start from the perspective of having data and models, and yet the whole point of doing a scenario is to cope with situations where you don't have either the data or a model, and geopolitics is clearly a prime example of that. The other thing is the NGFS scenarios are long-term systemic scenarios looking out to 2050 on alternative warming pathways, but actually right now financial institutions are making transition plans to hit interim targets in 2030. So global warming isn't a risk, it's a certainty. That's what the scientists are saying. The risks are extreme weather and transition risks, and in particular market risk. We have these ludicrous estimates, frankly, of minimal credit losses in 2050, and yet we've just gone through the most extreme period of volatility that the world has seen for decades, and this is completely lost on the NGFS scenario. So I'd be really interested to hear what exactly the NGF is going to do about its plans to produce short-term scenarios, which hopefully will include some of this kind of volatility.
Who would like to react to that? Olivier?
So I fully agree with you that that's precisely the plan. Of course, these are also very difficult phenomena to capture. So I would like also not to warn against kind of expecting too much from this work. It's not that we will be able to model climate change, economy, and geopolitics jointly. But certainly this will be part of the new vintage, and so we are working at that. We are thinking about this, and as I said before, it's not clear to me personally, what is even the sign of this relationship. So if more energy market volatility, is it good or bad for a faster transition? So even the kind of the sign of the derivative is not fully clear to me, but we can think of scenarios where the sign is positive or negative. So where they shifted to a quicker transition or less quick transition. So the answer would be, so yes, it's part of the plan, but don't over expect what we can deliver on that.
Thank you. We're over time, so maybe we'll just do very quick kind of summing up remarks. Satoshi, maybe I can go to you just for final 30 second or less final remarks.
Thank you. Well, in short, certainly scenario exercise, scenario analysis or stress testing exercise is a way to assess the future risks. And certainly, we always complain about the data gaps. But certainly, I think even the current NTFS scenario provides a reasonably sufficient data for making a certain judgment call based upon the results. And so, I think with admitting certain uncertainty around the results of the analysis, but still we can build on our judgment on that basis. That's, I believe, that the central banks and many financial supervisors around the globe are getting towards in the future.
Amazing, thank you. And Stephen, final remarks from you?
We've talked a lot about the risks. I guess two quick things. First, we can't overemphasize the urgency needed. And second is we can't ignore the opportunity. As we look at the transition, it's been projected there'll be trillions of dollars needed every year in new investment. Those are transition opportunities and risks as we think about these formulas.
Wonderful, thank you. David, final remarks from you?
I was sort of listening to the questions also, and I think what I hear there is at least remaining a bit of openness and flexibility. I think for the unknowns, and I think I can only agree with that. I think as I started, it's good that in some cases we've managed to make a transition from things that we wanted to understand better to quantification. But I think we should indeed always remain open to, let's say, new risks popping up and then basically going through a new cycle, I suppose.
Thank you. Elias, final remarks from you?
So I think that there's a lot of progress to be made in the technical part, if you want, in how we conduct scenarios. But we should not underestimate that perhaps the main area that we need to advance is in communicating these scenarios to the regular, to the public. Because I feel that we are doing a terrible job in underselling how serious this is. Because pretty much the analysis we make stays in this kind of symposium, or these discussions, and people in the street, they have no idea. They know that there's something potentially bad going on, but they don't really know the magnitudes. And I think we need to work a lot harder in bringing, our best forecast, our best analysis into communication outlets that can do the job in putting these things in the mind of people, whether, by a short report, a movie, I don't know, something that works. But if you ask anybody in the street today about climate change, what are the expected scenarios, people don't have a clue. I think that we need to do better in this regard.
Thank you. I think that's a really excellent point, and a question I did want to ask, but we didn't really have time, unfortunately. Olivia, any final quick remarks from you?
I mean, on the idea of the movie, we are in the NGFS team. We're also thinking of releasing a YouTube video explaining easily what the scenarios are. So hopefully this kind of goes a bit in the direction that Elias mentioned to have something. Also because the new generation, they don't really read. Our kids, they watch videos and they listen to podcasts. So we need to change the way we communicate if you want to reach them.
Wonderful, thank you. And thank you so much to my wonderful panelists today. I'm now going to pass on to my colleague Ellie Groves, who will be talking about nature risk, moving on to nature. So thank you again, everybody. Really appreciate it.